Good morning, everyone. Hope you're all doing well. Hope everything is good. It is Thursday, November 7th. Wow. Thursday, November 7th. Where has the time flown, my friends? So, we're deep into the week right now, and since we had the election on Tuesday in the US, we have pushed back by a day the Federal Reserve. The Fed day is here, right? The Fed day is today. Generally, a Fed day is on, on Wednesdays. But since we had the election on a Tuesday, the Fed day has been pushed back to Thursday. So what we got going on, we got a lot of noise here. That's what we got going on, this stupid construction. But the Federal Reserve, right? So we have yet another high potential of a rate cut, right? We have about, I think it's like a 90% chance of a rate cut that's shaping up today of 25 basis points. So in September, I don't know if you can even hear anything. This is just like this noise, this construction is absolutely insanity. But 9 a.m., geez. So in September, we had a 50 basis point cut out of the Fed. Today, we're expecting to see a 25 basis point reduction. We're seeing a spectacularly weaker jobs report in October, which a lot was due to the hurricane season and the disruption from there. It isn't expected to persuade policymakers to make a bigger cut, as they're likely to look at a particularly noisy October data. We also saw the Boeing strike that added to the two massive destructive hurricanes that are going to realistically affect those jobs figures. Also, we don't anticipate any color on how the second term Trump administration may affect the central bank, with Jerome Powell likely to say that the Fed doesn't take politics into account when deciding policy. But as you guys know, last time around, when Trump was president, Jerome Powell pretty much submitted a lot to Powell submitted a lot to Trump in wanting lower rates, so we could see a slightly more dovish and more easing of the Federal Reserve under this administration. So we also have Michael Kramer at Mott Capital Management, investing group leader for reading the markets, thinks the 25 basis point cut this afternoon will be the central bank's second blunder as the Labor Department keeps revising jobs numbers. The first was the 50 basis point cut in September. I think a lot of people agree that it was much more an aggressive hike than needed. I think that realistically, that 50 basis point cut for the first one in 4 years was a bit too much going into the next cutting cycle as markets were trading into all-time highs. We're not really leaving too much wiggle room or data dependency in that matter, because it seems like they're kind of preemptively doing these cuts for a bigger reason. So the inconsistent jobs data alone should give the Fed a reason to pause and not cut rates in November, or at least until the Fed gets a better handle on the trend of jobs data, because again, the labor market is very tight right now. So in this cut cycle and cutting more aggressively, it doesn't really sing the best of tunes for what may come down the line realistically. So with these jobs figures and current economic standing, I think that the Fed is ignoring a lot of big data points when doing these cuts. And we also saw that the 10-year benchmark yield has risen since mid-September, tacking on 0.75 of a percentage point that hit 4.47% on Wednesday. And it's primarily because the Fed only controls short-term rates, with longer-term borrowing more associated with longer-term monetary policy and the fiscal landscape, as well as economic conditions like growth and inflation. So fears of rising debt levels are at a forefront of the investors' minds, as it will challenge for the incoming president to deal with budget sustainability amid bloated discretionary spending and growing burden from the entitlement programs. Now, it's a big factor that we saw the 10-year yields rising as rates, obviously the rates, like I said, are affected mainly on the short end of the curve by the Fed, but still with these longer term rates rising in a condition where markets, or I should say the Fed is cutting rates, is a pretty big concern overall, right? It's putting a lot of downside pressure in the bond market, and it seems like these cuts and this kind of easing in these rate cuts isn't necessarily as effective on the immediate term as people would have hoped. And I think that a lot of this, right, turns into more of a recessionary pressure, because if inflation figures continue to increase as rates kind of increase on these yields and bonds continue to blunder, right, those inflation pressures aren't going to go away until we start to see a larger downturn or even recessionary pressure in the market. So we're not yet necessarily calling the 10-year Treasury yield to reach about 5%, but the bond vigilantes seem to be threatening to take it there. We're seeing a lot of downside momentum that's happening in the bond market. It's consistent, it's persistent as rates continue to rally. We saw that investors often here don't fight the Fed, but perhaps it's the Fed that shouldn't be fighting the bond vigilantes. The bond market could easily nullify the impacts of another rate cut, as we've seen, right, recently, and that's because the bond market believes that the Fed is cutting by too much and too soon, and is therefore raising long-term inflation expectations, and these expectations are heightened by concerns about more fiscal excess for the next administration. So where does that leave us off? That leaves us off with like a continued slow grind in the equity market that skews valuations while the bond market continues to plummet, eventually leading to a very big divergence between the two, and more so of a discrepancy and maybe pulling away from what we might call a soft landing in the coming year. So this morning we had some initial jobless claims. We have wholesale inventories. We have EIA natural gas, and then the main thing, we have the Federal Reserve at 2 p.m. Eastern. We're going to take a look at that with our group into this afternoon, see what kind of possibilities shape up from there. But honestly, this week has been tacked on with a lot of news, a lot of uncertainty, and I just kind of want this trading week to be over. There has been great opportunities, but I think that I've put my risk on and I've done what I needed to do realistically to end this week. And I want to be very, very careful going into this Fed announcement, especially in this week. If you're not used to trading Fed announcements in general, this week is probably one of the Fed announcements that you might want to miss. So we'll see how that shapes up into the afternoon. In terms of the equity market right now, we're just persistently continuing this grind higher, right? We have to acknowledge that. We've made heavy volume P-shaped distributions over the last few days here, and we're just like continuing that kind of upside in these markets. So as long as we're closing continuously above this larger auction and these P-shaped distributions, we're going to see that continued excess movement to the upside. So realistically, shallow pullbacks on the S&P, 59.50 to 55 area, I'm expecting to see hold, and then 35 is like kind of those later chances for those longs. Anything under 59.10 today, right? We have Jerome Powell. He could easily change the trajectory of this market. We're probably going to see some downside under 59.10 that can clean up a lot of this upside auction that has happened. So apologies for the construction today. I kind of just want to keep this brief because it's just like drilling a hole in my head right now. And we'll see where that goes, but take it slow and steady into today's afternoon with the FOMC, and I hope you all have an amazing trading day. Ideally tomorrow, this shit doesn't sound like this, so we can do a stream in the morning. Otherwise, I might have to just like not do the stream in the Friday session. I really want to, but honestly, this is really, it's a little triggering here. So we'll see how that